Making money on the stock market in 2025. I just checked the latest news from Bank of America and their new bold calls on the Federal Reserve interest rate policies, as well as the most juicy sectors where to invest this year. And trust me, this is something that you don't want to miss. So stay with me. Anyway, as always, before diving into the topic, subscribe to the channel, leave a like and share this content to grow the community together. And now, let's begin. First up, interest rate policies. That is the first and greatest elements creating volatility in the market. And for those who are interested on profiting on volatility, this is a core element to take into consideration whenever we decide to trade and invest. Here's the headline: Bank of America just decided to revise its forecast. In fact, according to their US economics team, the cycle of interest rate cuts is over. Kaput. Not anymore. Nada. No more rate reduction on the horizon. As you can expect, the reason for the revision is the resilient labor market, notably after the December job report came in hot, with a significant payroll boost and unemployment ticking down to 4.1%. This data led Bank of America to conclude that economic conditions no longer justify further easing. From my side, I pretty much understand their thinking, since inflation is still a thorn on the Fed side, sitting stubbornly above the 2% target. And even the Fed projection for 2025 suggests inflation risks are skewed to the upside. Meanwhile, Bank of America doubles down and notes that the labor market has stabilized after the summer volatility, and they expect upcoming revision to be minimal. No drastic trend change. So, long story short, what does it mean for us investors? First, let's remember that rate cuts are only one piece of the puzzle. Still, rates work as gravity for the stock market, as Warren Buffett said. The higher the rates, the higher the likelihood of stocks going down, as it works for gravity indeed. Now, here's my personal take. The market constant obsession with guessing the Fed next move is, frankly speaking, a nonsense. Follow me for 1 second. If you think about it, a strong economy is the ultimate driver of business performance. And if you are betting on good companies with strong performances, backed by strong fundamentals, you shouldn't lose sleep for 25 basis points rate cut or increase. So every minor adjustments in the interest rate environment doesn't really change your investment case. And as Warren Buffett wisely says, focus on understanding the business you are investing in and disregard what you cannot control. In brief, panic over interest rate, a total distraction. What matters is whether your company are strong, resilient and well positioned to weather short-term noise. Their strengths will eventually reflect in the stock prices. Think of it this way: the crazy cheap share prices hit the market because everyone else is panicking. And that's your signal to act. Buying when others are fearful, hold on to quality and enjoy the feast once the dust settles. Because remember that investing is about seizing opportunities and not reacting to guesswork. And now let's move on to the second part of the video that is dedicated to understand the trends for 2025. Bank of America analyzed 10 different scenarios that could shake the market this year. These high-impact contrarian predictions are poised to challenge, for what I can say, conventional wisdom. For this reason, I would like to start big, since Bank of America expects the S&P 500 to run over 20%, while Wall Street consensus expects roughly a 10% return. Bank of America suggests that a production boom, potential corporate tax cuts, and steady inflows from passive funds could keep the bull market roaring. And this is going to be definitely a plus. So take note. Second thing that BoFA keeps into consideration are the tariff policies. Contrary to the narrative that tariffs are just a tax on consumers, BoFA suggests that they may actually work. By pressuring countries with trade surplus, tariffs could drive higher the US production, bolstering employment and increasing wages. A controversial take, but worth watching. Plus, the regulation can unlock a wave of capital expenditure. If the new government initiatives cut through the red tape, we may see businesses ramping up investments, driving in turn significant economic growth. That, in the best case scenario, could drive an industrial boom. So another plus to add to our list. What we never miss at this point is a mention about artificial intelligence. And in this regards, AI could hit a plateau, according to BoFA, warning that the industry may exhaust human-generated data to process and train the AI engine, let's say, slowing the rapid advancement that we have seen until this point in time. And by the way, also Elon Musk back this view. But frankly speaking, I don't buy too much, because human-generated contents are everywhere and are produced daily and do not belong only to the internet sphere. There is also an incredible amount of information that we produce, but we do not deploy into the internet. So my conclusion is that AI will keep evolving rapidly, maybe in different ways that we have seen until now. Still will be a critical element to take into consideration for our investment strategies. Talking about bonds, on the other hand, domestic buyers of government bonds may start pulling back after years absorbing treasury losses. If this happens, it could change the sustainability of government debt and reshape the fixed income market. So let's keep an eye open also on the bond market. The lower the appetite for the bonds, the higher will likely be the appetite for stocks. Moving continent and talking about Europe, the Eurozone might break free from fiscal constraints, with Germany increasing its investment in energy and defense, and European equities in general becoming more and more attractive as value play, given the massive discount compared to the US peers. Anyway, not everything is sunshine and rainbow. A stronger Japanese yen, driven by tighter monetary policy in the samurai market, could reverse capital flows, negatively impacting US growth stocks. So between Europe and Japan, we have food for thoughts that could reshape international investing strategies, adding up on volatility, I would say, driving potentially higher the demand for alternative assets, like ETF and 401k plans, just to be on the safe side. And while this expands opportunity for retail investors, BoFA warns that there are risks for transparency, given the potential numbers of new access points. Second last point that I would like to tackle are geopolitical tensions that could escalate, leading to international disruption of subsea cables, threatening global communication and financial networks. Last but not least, an aging infrastructure and the rise in renewable energy could lead to passive power outages, and Bank of America emphasized the urgent need to invest in grid resilience to avoid massive disruption. These are the scenarios provided by Bank of America for 2025. They may seem contrarian, but they are worth keeping on your radar. As always, preparation and adaptability are key to thrive in unpredictable markets. And we all know. Drop your thoughts in the comments down below. And if you found this video insightful, don't forget to subscribe to the channel, leave a like and activate the bell for more deep dives into the market trends. See you in the next one. Cheers!